Well, the big story is the sharp Wall Street sell-off in reaction to the hawkish FOMC cut. So let's listen in to what Fed Chair Jerome Powell had to say about the outlook going ahead.
Today was a closer call, but we decided it was the right call because we thought it was the best decision to foster achievement of both of our goals, maximum employment and price stability. We see the risks as two-sided, moving too slowly and needlessly undermine economic activity in the labor market, or move too quickly and needlessly undermine our progress on inflation. So we're trying to steer between those two. You know, we've done a lot to support economic activity by cutting 100 basis points, and that's a good thing. I support the decision, and I think it was the right decision to make. I think from now, we are in a place where the risks really are in balance, and we need to see progress on inflation, and that's how we're thinking about it. So it is kind of a new thing. We moved pretty quickly to get to here, and I think going forward, obviously, we're going to be moving slower, which is consistent with the SEP.
Well, there's a lot to talk about, isn't it? And Mr. Powell has given us a lot to talk about. Ed Yardeni is with us. He's president of Yardeni Research. Matt Orton, chief market strategist at Raymond James Investment, is also now with us. Gentlemen, good morning. Great to have you with us here. So, you know, I was saying this, Ed, earlier. Actually, the conditions remain largely same. September economy was looking strong. We got a cut here. Economy largely, all data lately has been strong, and we got a sort of very constrained kind of a cut with a dissenter and then pulling back in 2025, etc. Your thoughts, Ed, what we saw and the market reaction then?
Well, none of this really surprises me. I thought before the September 18th cut that they wouldn't cut, or they wouldn't cut by more than 25 basis points. I felt the economy was resilient, was showing a lot of strength, and they really hadn't quite accomplished their mission. They weren't quite at 2%, but they just wouldn't listen to me. And they went on and cut it by 50 basis points, and then about another 25 basis points in November, and yet again today. And so they are down 100 basis points, but the economy is demonstrating that they may be stimulating an economy that's already quite strong. And what we've gotten out of that is a melt up in the stock market. And now with the Fed changing its mind and saying, you know what, maybe we need to slow down here. Maybe we need to pause for a while. The market's had a real significant sell-off here. But this is a healthy development because I think the market, I didn't want to see a melt-up occurring in here, and I don't mind a bit of a correction.
But Ed, how much of a correction here on the S&P, say, for example? We lost about 3% last night.
Right.
Yeah.
Well, it's pretty powerful it was pretty powerful to the upside, and it could be pretty powerful to the downside. You know, there's still people who have huge capital gains from the bull market that started in October of 2022, and many of them probably would like to sell, but if they sold now, they'll have to pay taxes on those gains. So I think a lot of people were waiting until January to sell. So we could still have some of that ahead of us. And then, of course, we got the potential for tariffs on the day one that Trump enters the White House. We have the potential for a government shutdown because once again, Congress can't agree on what kind of budget they should have. So I would say that this could last a few weeks into January, and it could be as much as 10%, maybe 15%.
10 to 15% correction for equities on the cards. Matt, hi, morning. So come in first on the Fed projection, what you made of it, the kind of market reaction that we've had with markets nosediving, and do you anticipate a correction? And one more, when could the first rate cut come? We're talking about two, but are we in for at least a prolonged pause, say for the first 6 months?
Hey, good morning, Rima. Always good to see all of you. And I think what we got from the Fed today really wasn't all that surprising. At the end of the day, we knew with pretty much certainty that they were going to cut rates today. Whether they should or shouldn't is a different story. But I think what maybe the markets got a little bit spooked of was a confirmation by the Fed that inflationary pressures are building, and that the change in the summary of economic projections and the change of the dots is leaning on the more hawkish side. But when I look at the sell-off and I look at what the Fed implications are with the totality to the underlying market thesis, which is earnings growth, the fact that we have broadening earnings growth that really for the past 2 quarters or so has been translating into increased price spread, the past week or two outstanding, those trends are still there. Economic growth is still there. The reason that the Fed is pulling back a little bit is because growth is still very strong, and we're potentially worried about a combination of more pro-growth policies intersecting with the uncertainty of what tariffs could look like. And so to me, I think these sorts of pullbacks could be good buying opportunities for the market. As you all know, I've been optimistic for a long time. And while I might not be willing to step in right now because I just think there's a lack of bids, we're heading into the end of the year where the S&P 500 was up almost 28% heading into today. So I just think a lot of investors don't want to step in and potentially give up gains if they're on the wrong side of the trade. But there'll come a point where the market looks very, very oversold, and the long-term fundamentals of many, many companies is going to propel the market higher again. So I would tell investors, as I have been, use downside opportunistically, because nothing the Fed has said changes my opinion. And whether we get 2 cuts next year, 3 cuts next year, probably March is going to be maybe the time where we look for another cut. That's still supportive. Rates are still coming down, maybe a little bit more slowly than we originally projected.
All right, got that, Matt. Thanks for that. Good morning, gentlemen, and welcome to the show. Ed, the last time we chatted, you said you're not too optimistic about the cuts and you don't expect to see a melt up towards the end of the year. Boy, oh boy, you were bang on that. But what's the way ahead from here on? The US markets, you're saying maybe it corrects 10 to around 15% odd. What about the Indian markets? We have had a good run. We have pulled back a little bit as well, in the recent past. But what kind of a correction do you see in the Indian market? And where does India now come in the emerging market basket?
We've got a stronger dollar now. We've got a Fed that's somewhat less dovish. I'm not sure I would call it hawkish at this point, but that takes some of the excitement out of emerging markets generally. And of course, the emerging markets that have done the best are the ones where there are profits to be taken in the event of some disappointments about the outlook for interest rates, particularly in the United States. So I think India is prone to the same kind of correction that we're likely to have in the United States. But I agree, these are still bull markets. I don't see a recession occurring anytime soon. And without a recession, I think the most that we get is a correction of 10, 15%.
Matt, just to put numbers to that view, you said things can get very oversold. But what will be very oversold? You want to sort of as Ed did, you want to put some numbers to it? How much can this go?
Yeah, I don't even know if we have to hit 10 or 15% down. Honestly, that sort of pullback in the U.S. market, I've been telling clients, isn't off the table for 2025. Okay. My expectation is that we have a good market with increased volatility. But even a sell-off of call it 8% or so, I think would be par for this uncertainty we have. But it would be healthy to get more long-term investors back into the market. And there's nothing wrong with that sort of a sell-off in the context of a broader long-term bull market. So there's definitely room to go. And I think India in particular is less prone to that sort of a sell-off because you've just gone through a 10% plus pullback. And I think you're seeing strong domestic demand. The FII demand, I think, is down because it's in sympathy with what's happening in the US. And I think a reticence to take on additional risk heading into the end of the year. But again, the fundamentals look very, very strong across a number of companies. And those high quality assets, like we've talked about before, some of my favorite names in the auto space, the financial space, some of those have held up better than the rest of the market. So again, sticking with quality is another really important way to navigate some of this volatility. And you can pick up these high quality assets at a discount during the sell-offs. That's a good thing for long-term investors.
No, absolutely. Ed, just one other thing, new development, right? Which is this, the U.S. government shutdown, which now looks likely on Friday, because now there is a stopgap bill, but it's not been voted on. It doesn't look like it'll be voted on. Trump and I think post the New York close, they came out and said that they want the bill to be passed, to be debated now. And they also want a spending increase, right? I mean, you had Mr. Musk on X, very loudly expressing his views about how people. That's who correct, say yes to this bill should be voted out. How should we read this, Ed?
That's correct, yeah.
How should we read this? Well, I think the
Well, I think you put it in the list of things that can go wrong in the short term that might continue to feed this correction. I mean, that news that you just mentioned came out today, in addition to what the Fed was doing. So I think the markets are rightly concerned about some confusing signals from monetary policy and fiscal policy. And I think there was sort of a widespread consensus that a lot of things are about to change, but they'll, on balance, will change in a positive way. But it's never quite that easy. It can be quite sloppy, and I think it's going to be sloppy for the next several weeks until things kind of all settle down and we see what makes it through Congress and what doesn't.
No, is it the first signs of a bit of a struggle between Mr. Musk and his views on? I mean, he's promised to cut $2 trillion in federal spending, and what the incoming president and Republicans would want to see happen. I mean, there's a disagreement there, right? I mean, with this at least right
well,
now.
look, Musk is not in the government. He's an advisor. He's become there's a bit of a what would we call a bromance between Musk and Trump, and maybe there's going to be some stresses and strains along the way. But at the end of the day, Musk is, I think, going to recognize that the president of the United States is the one who calls the shots. But I think he's right to point out that at some point here we have to end this Christmas tree approach to dealing with fiscal policy. We just can't keep putting more and more presents under the tree. And so I really don't have a problem at all with Musk expressing his opinion. But at the end of the day, people like Representative Johnson, who is going to head up the Republicans in the House, has to get the government to work, and that may require some compromising. It's not going to be a perfect situation for anybody.
We're in for some uncertainty for sure. Matt, just a quick word on the Indian markets. You spoke about how India is relatively much better placed. But will the FIs continue to remain reticent about investing in India with the dollar index now at a 2-year high and crossing 108?
Yeah, Rima, it's a good question. It's certainly a headwind to the FII story with respect to India. But I think this knee-jerk reaction with the dollar higher, I'm not sure how much further that's going to continue or how long that's going to continue. So whether or not it moves a little bit higher, markets trade a little bit lower in the very, very short term, again, it just creates more of an opportunity. But when you come back to whether or not that changes the underlying fundamental growth story, the big secular growth tailwinds that are driving the investment case for India, it doesn't. And I think when US investors look for ways to diversify their portfolios, especially as these known unknowns I've been talking about with respect to policy moving forward earlier in the year come to bear, I think finding some of those countries where the growth is a little bit less related to just politics in the US, I think that becomes a very important asset and diversifier, especially when you look at other places like Europe, other parts of Asia. You look at the issues that are happening in Korea right now, Taiwan being entirely driven by semiconductors. I think India looks like a very, very attractive way to diversify away some of your risk and concentration risk that you have in the US. So I think they will eventually return, especially because I think the Chinese story just continues to disappoint. And that money, I think, eventually slowly keeps moving back to India.
Matt, Mr. Yardeni, thank you very much for joining in for now.